Have you ever lost money on an investment? If so, you're not alone. Investing can be a great way to build your wealth over time, but it's important to avoid making common mistakes that can derail your progress. And in this video, I'm going to share with you some of the most common investing mistakes that people make so that you can avoid them and reach your financial goals. An important error that investors often make is entering into investments without doing the necessary research and careful investigation. Investment involves having a good grasp of where your money is being placed, whether it's in stocks, bonds, real estate, or index funds. Neglecting to examine the basics, review past performance, and evaluate possible risks can result in unwise investment decisions and significant financial setbacks. By committing time to research and keeping up with market trends, you can make more informed investment choices, greatly improving your chances of achieving success. Moreover, investors should also pay attention to comprehending the financial well-being of the specific companies or assets they are contemplating for investment. This entails scrutinizing financial documents, appraising the leadership team, and examining the competitive environment. By delving into these particulars, investors can acquire valuable insights and arrive at better informed conclusions. It is essential for investors to have faith in their selections and avoid making purchases solely based on intuition. Feelings have a notable impact on investment choices, frequently causing irrational decisions that can hinder long-term profits. Anxiety and desire for profit are typical emotional instigators that obscure good judgment and encourage impulsive actions among investors. Becoming anxious during market declines or investing in a stock solely because of its popularity can result in significant financial setbacks. Responding to adverse or favorable news stories can also affect sound judgment, leading to hasty responses. To steer clear of making decisions based on emotions, it is vital to embrace a disciplined approach. Establish investment objectives and adhere to a well-defined plan. Investors can counteract emotional biases by setting transparent investment standards and adhering to a predetermined set of principles. This might encompass determining the maximum portion of one's portfolio assigned to a single investment, devising an established exit plan, or seeking guidance from a dependable financial advisor. Keep in mind that alarming news headlines are crafted to evoke emotions, and there will always be something to worry about. Try to disregard these momentary feelings and concentrate on the broader perspective. Putting all your resources into one place is a recipe for trouble when it comes to investments. Not spreading out your investment portfolio makes it susceptible to losses if one type of asset or industry doesn't do well. By spreading your investments across various sectors and types of assets, you can decrease risk and safeguard your investments. A well-spread portfolio creates a balance between risk and reward and can protect your investments from unexpected events. Diversifying means spreading investments among different kinds of assets, like stocks, bonds, real estate, and commodities, as well as various industries. For instance, avoid concentrating too much on your employer's company's stock. This approach helps minimize the impact of one investment doing poorly on the whole portfolio and allows investors to benefit from different sectors or types of assets potentially doing well. A well-diversified portfolio offers the possibility of steady returns and helps investors handle market changes with more resilience. By embracing a diversified strategy and sticking with well-rounded choices, such as broad market index funds and ETFs, investors can enhance their chances of achieving their financial objectives. When dealing with the challenges that come with investing, attempting to time the market is a risky endeavor, even for seasoned professionals. Market timing, which involves trying to buy when prices are at their lowest and sell when they're at their highest based on short-term market movements, poses significant challenges. Accurately and consistently predicting short-term market fluctuations is exceedingly tough, if not impossible. Investors who actively try to time the market often miss out on potential long-term gains or make poorly timed investment decisions that can harm their portfolios. Rather than getting caught up in the elusive pursuit of market timing, a wiser approach is to focus on long-term investment by adhering to a well-defined strategy that aligns with financial objectives and risk tolerance. Investors can endure market ups and downs and benefit from the compounding effect over time. Embracing a patient and disciplined mindset enables investors to recognize the futility of market timing and instead remain invested throughout the market cycles, seizing the potential rewards of long-term market trends. Nevertheless, let us know your thoughts in the comments section. Attempting to outperform the market is a common mistake that many investors come across. While the idea of surpassing the market and achieving better than average returns may be enticing, it's essential to recognize the challenges even experienced professionals face in consistently exceeding market performance in the long run. The pursuit of outperforming the market often carries various drawbacks and risks. The desire to beat the market can lead to unwise investment choices, influenced by speculative or short-term thinking, as investors might be tempted to chase the latest trends or popular stocks. Instead of solely fixating on outperforming the market, a more sensible and realistic approach is to stick with a dependable investment strategy that aligns with long-term goals. Trying to consistently outperform the market is a difficult endeavor. Successful investing necessitates patience, self-control, and a focus on the long run. It's crucial to realize that investing isn't a quick way to get rich, and expecting instant or consistent high returns is a common error that can result in frustration and hasty decision-making. Financial markets go through periods of growth, stability, and decline, with short-term ups and downs being a natural part of the investment landscape. It's essential for investors to resist the urge to constantly check their portfolio and make frequent adjustments based on these short-term market shifts, as this reactive approach can undermine long-term objectives. By maintaining a commitment to long-term goals and sticking to a structured investment plan, investors can endure market declines, steer clear of hasty decisions influenced by short-term changes, and improve their prospects of attaining investment success. Embracing a patient attitude enables investors to navigate the intricacies of the market with strength and a belief in the potential for long-term financial advancement. Dependence on advice from friends or family, or simply going along with the crowd, is a risky mistake in investing. Typically, when a tip becomes widespread among the general public, the opportunity for significant profits has already passed. Furthermore, blindly following the masses can lead to speculative bubbles and herd behavior, where investors inflate the prices of assets beyond their actual worth. It's essential to critically assess investment suggestions, perform independent research, and make informed choices based on your personal financial objectives and risk tolerance. Seeking guidance from trusted financial professionals can also offer valuable insights to avoid getting caught up in the trend or following the crowd. In conclusion, successful investing is a journey that requires careful planning, discipline, and a long-term perspective. Avoiding common pitfalls such as emotional decision-making, attempts to time the market, and blindly following trends is crucial for achieving financial success. Instead, consider a diversified approach, maintain a patient mindset, and rely on sound research and advice from trusted experts. By adhering to these principles, investors can navigate the complexities of the financial markets and work toward their long-term financial goals with confidence and resilience. That's it for today. Thank you for watching, and don't forget to click the like and subscribe button.